Welcome to Financial Reporting Conversations, brought to you by Basford Consulting. We're here to make the unknowns of accounting and auditing and climate standards known, so you can avoid the blind Freddy mistakes and do financial reporting better. Each episode will unpack what the standards really say, what they mean in practice. Whether you're a preparer, auditor, director, or litigator, our aim is to help you get it right.
Morning, Siobhan.
Morning, Wayne.
Welcome to our inaugural webcast. Great to have you. And this morning we're going to be going through myths about S2 reporting and try and do some myth busting. So see how we go. So run first through some true, false, yes, no answers, and then we'll go more detail after that. So is it true S2 is all about greenhouse gas emissions?
False.
Is the boundary for recognition and measurement of greenhouse gas emissions the same boundary for your financial report? So is it a AASB 10 boundary?
Not always.
Is it true I have to use the greenhouse gas protocol to measure my greenhouse gas emissions?
That's not true.
Is it true I must have a transition plan?
That's also not true.
Is it automatically assumed I must report I'm exposed to climate-related risks?
This depends.
Okay.
Yep.
Okay. Is it true I can report using double materiality and still comply with AASB 2?
This is neither true or false.
Must I disclose industry-based metrics?
No.
If I do disclose industry-based metrics, I must use the SASB or IFRS industry guides.
No.
Is it true I must obtain data from all the businesses I interact in my value chain to do my GHG reporting?
That's not true.
Is it true I don't have to engage with the primary users to prepare the climate statement?
That's not true.
Is using carbon credits bad?
No.
Okay, I'm in the emissions or carbon intensive industry. Therefore, I'm going to be punished when I issue my climate statements?
No.
Is it true I have to set up a completely different risk management arrangement to manage my climate-related risks to the risk management system I use for the rest of my business?
That's also no.
Is it true I have to redetermine my climate resilience every financial year?
That's not true. Yep.
And is it true I have to prepare scenario analysis every year forever going forward?
That's not true.
Okay, thank you. So let's go through those myths. So there was a lot of not trues, not trues. I may have said false, but you said not. You said not true. So let's go through these untruths and the myths that are there. So when we're looking at what is S2? Is it all about greenhouse gas reporting? Is it all about reporting your scope 1, scope 2 and scope 3 emissions?
So this is not true. AASB S2 only directly refers to greenhouse gas emissions disclosures in the metrics and targets pillar. Entities really should be cautious of falling into the trap of overemphasizing the importance of their greenhouse gas emissions disclosures, because as we know, there are many other disclosures required by AASB S2 that are equally relevant and may also require more resourcing, skills or capabilities than that required in preparing your greenhouse gas emissions disclosures. And one of the best examples in this space is obviously your scenario analysis or your climate resilience assessment.
Everybody that's just focused, I listen to so many people telling me about scope 2 and nightmares about scope 3. I listen to auditors getting very excited that the GHG component of S2 is auditable. He's got numbers in, therefore I can audit, but that is a complete myth, and everybody should be focusing on the entirety of S2.
Yes, the entirety of S2.
Okay, a worrying one for somebody that lives and breathes by financial statements, and I understand my consolidation and I understand what is in my group of my financial statements. So you said the boundary for recognition of measurement of my greenhouse gases is not the same as my world of financial reporting. It is not the same as AASB 10.
That's correct. It doesn't have to be. While AASB S2 and IFRS S2 require the use of the greenhouse gas protocol in most cases, there is a understanding that because the Global Greenhouse Gas Protocol is a third-party standard and it has different recognition measurement methodologies, and because of that, and because of the different purpose of that the greenhouse gas or the Global Greenhouse Gas Protocol serves, it's not unusual that you might have slightly different reporting boundaries for the purpose of your financial statements versus for the purpose of producing a greenhouse gas emissions statement under the Global Greenhouse Gas Protocol. S2 dictates the recognition or measurement criteria that must be used in measuring your greenhouse gas emissions, but how the entity actually applies the requirements in that protocol or another relevant measurement protocol that's permitted is really up to the entity.
Thanks, Sean. And that is presumably going to be very confusing for auditors and users. Would you expect people to disclose their boundaries for their
yes.
greenhouse gas reporting?
So one of the disclosure requirements within the metrics section, one of the cross-industry metrics does highlight that where these boundaries differ, you do need to disclose how they differ so that users can understand how you've calculated your greenhouse gas emissions and how you've set the boundaries in comparison to your financial statement boundaries.
I'm sure that will be clear for all of us. Another false or not true that you came up with, you said, I do not have to use the GHG protocol to measure my greenhouse gas emissions?
That's correct. So both IFRS and AASB S2 do have a bit of a caveat, and they do say that if you are required by law or regulation to apply another greenhouse gas measurement protocol or framework, in this case in Australia, we obviously have the National Greenhouse and Energy Reporting Scheme legislation, and entities within that scope are permitted to continue to use that protocol to measure their greenhouse gas emissions, as opposed to having to apply or redo their greenhouse gas emissions calculations using the global protocol.
I presume this is going to make life extremely easy. Now, is NGAS close to the GHG, or is this the situation where NGAS is behind GHG?
This is a very good question, actually. Luckily, NGAS in Australia is very sophisticated. So what it has done is it's aligned with the Global Greenhouse Gas Protocol, and it's a similar approach to how we deal with accounting standards in Australia. So we don't carve out, we just limit what can be done, or we limit the optionality. So the Global Greenhouse Gas Protocol has a lot of options on how you're allowed to measure and set boundaries, whereas NGA limits those options and tells us you're only allowed to measure things a certain way, and they provide that information and they disclose exactly what you have to comply with. So if you are reporting under NGAS, you do comply with the Global Greenhouse Gas Protocol because you are still using methods and measurement techniques that are aligned with the global protocol, but the reverse can't be said. So if you are complying with the Global Greenhouse Gas Protocol, there may be instances where you don't align with NGA scheme legislation. But what it does mean is if you are an NGA reporter, it's not that big a deal. You do have the freedom to continue using it. It is aligned. It's not going to require you to do masses or mass amounts of recalculations to get to where you need to be to comply with S2.
Are we going to then potentially see hybrid measures? So my onshore operations will be using NGAs, and my offshore operations could be using a slightly different version?
Possibly, yes. but that's just something we have to live with in this case. This will be the case for everyone. Because the global protocol has optionality, you can't say, or we can't make the conclusion that if you apply NGA and you apply a slightly different measurement approach for offshore work, that optionality and those differences would still occur under the global protocol. It's not just limited to applying NGA.
Thanks, Siobhan. I am fascinated with this consolidation concept. I live in a world of consolidation. I live in a world of group audits. And the more I put my mind to how people can prepare a consolidated climate statement and then audit a consolidated climate statement, or review a consolidated climate statement, it gets very, very complicated in my mind. So another not true. So I don't have to have a transition plan. I thought that adopting S2 was I'm going to transition into this new scenario, this hotter scenario or wetter scenario. So it's not true. I have to have a transition plan.
That's correct. So S2 does not actually require you to have a transition plan in place. It only requires you to disclose material information about your transition plan if one exists. But as with all things, you might feel as a preparer that it would be best to develop a transition plan once you realize or once you've identified those material climate related risks and opportunities that you're exposed to, because your transition plan will take into account how you intend to mitigate those risks in the short, medium, and long term. So it is just something to think about. You don't have to have one in place right now in your first year of reporting, but you may find it useful to develop one and report on it going forward.
And again, a transition plan would be based on the logic, I have identified risks and opportunities that I need to transition to or from.
Yes. So transition plan is about how you're intending to limit your emissions exposure or limit your exposure to climate-related risks and how you're managing that. So how we're moving from our current state into a low-carbon economy.
And I think this follows on to another one. The next myth was when I'm preparing my climate statement, I have to tell people I'm exposed to climate risks.
It's a more difficult one because it's true and false in some ways. If you are scoped into mandatory reporting underneath the Corporations Act, it's assumed that you have climate risk. And that's for Group 1 and Group 2 entities. Group 3 entities are the only entities that are permitted under the Corporations Act to exercise judgment about whether they have exposure to material climate-related risks and opportunities. Otherwise, for Group 1 and Group 2 entities, it is assumed that it is material and you do have to report in accordance with S2 and the requirements in the Corporations Act. And that is because the government, when they were developing these amendments to the Corporations Act and they were working with the AASB, there was this belief that a vast majority of entities would be exposed to climate-related risks in Australia, material climate-related risks, and that Group 3 entities, there wouldn't be as many who would necessarily have material climate-related financial risks. So to make things a bit easier in terms of application, there was an assumed level of risk that bigger companies are exposed to, and then the smaller companies get to make their own independent assessment as to whether or not they have exposure to climate-related risks.
Now, you touched on the phrase material.
Yes.
Now, I can understand, and I am a very boring traditional financial reporting person that used to understand materiality. So I can understand the concept that climate-related risks is material to a user. I can understand that. But I'm not convinced all entities will have identified material risks. So how do I square that up? So I have done my risk assessment and I have determined, certainly in the short or medium term, I just cannot see any material risks. What am I supposed to disclose in my climate statement?
If you're a Group 1 or Group 2 reporting entity, you will have to find something, because you can't say that you don't have material risk in this space. But if you're a Group 3 reporting entity, you just have to disclose that you are not exposed to any climate-related or any material climate-related risks or opportunities, and provide details on how you reach that conclusion. And then that statement does have to be assured as well by your assurance provider. And as part of that, they will need to go through the whole process and make sure that there are appropriate systems and internal controls in place that support that conclusion. So it's going to be probably, I would say, the same amount of work from an assurance perspective if you've got material risks as if you don't.
I'll still play on this subject because I am confused. So Group 1, Group 2, so I'm it is deemed that climate-related risks will be material to the user. I have looked at it, and apart from airfares might go up a bit, apart from my fuel bill might go up a bit, I'm convinced, and I might need more aircon or less aircon or etc. Your comment was, I still must put something.
Yes.
Is there any guidance on how much of if I now think I've got a whole selection, potentially, theoretically, of immaterial risks, that because the Corporations Act insists I put something, do I put some of them, one of them, all of them?
That's a judgment call for the preparer to make. I mean, realistically, you try and focus on what's most relevant to your business and what you would think would be of most interest to stakeholders.
This will be, and now for auditing, because I audit it, review it.
Yes.
Am I going to say, well, I think you've missed one of the boilerplate shopping list of potential, or am I just happy that it's your judgment that you've decided these are the risks that you believe are material?
So from an assurance perspective, materiality is even more interesting, and the determination of what's material is much more interesting, arguably, because it's not the assurance practitioner's responsibility to judge on what the client has identified as being material. However, in order to assess completeness and make sure that the client is disclosing the right thing and focusing on the right thing, they do have to have a knowledge of the industry in which the entity is operating in, and if there are multiple industries, like each of those industries, they do need to have a good understanding of the location and geography in which the entity is operating as well, and what some of the common risks would be given where the entity operates, how it operates, and where it sits in the value chain as well. So an auditor or an assurance practitioner should have a good idea of what might look or what might be material, what the risk assessment should look like, or the outcomes should be, and then they apply that knowledge as well. And it's about talking to the client and identifying where areas or where differences are to see if the client has considered those and the reasons why they would have not have assessed them as material, where a peer within the industry might have identified that risk as material for themselves.
I say I'm an old auditor that used to understand materiality. I still think I understand materiality being a base concept. It would impact a decision of an investor with limited resource. So I live still in my belief that is still the underlying concept in both S2 and 5000?
Yes and no. I can't give straight answers here. In S2, it's very straightforward. We have the same definition of material as we do in accounting standards, and that is from a user perspective. And not just any user, we are only focusing on the information needs of primary users. And we're not just focusing on any information need from them, we're only focusing on the common information needs. Because as we all know, we cannot be everything to everyone. When we look at materiality from an assurance perspective through 5000, ASSA 5000 is it's intended to be agnostic. So it is intended to audit or assure any sustainability framework, not just S2. And because of that, it has a slightly different approach to materiality, so that if your client is reporting under a double materiality framework, like the European Sustainability Reporting Standards, or if your client is using an impact materiality framework, such as the GRI standards, you are able to still use all of the information and the guidance and the requirements in ASSA 5000 to assure that information. So a lot of what we are looking at in materiality when we look at it from an assurance perspective is understanding who the intended users are and adjusting your assurance engagement to match what's needed.
And I know I'm very likely going to regret the next question. For me and people listening, would you like to give us a very simple overview of this concept that everybody talks about, and I'm not convinced it really applies in Australia, of double materiality? Because I go to a lot of talks where everybody is talking about it in English, in Australia, in the context of S2, they talk double materiality. In my world, double materiality exists in this very strange European world of environmental reporting, and is something I sort of watch from 10,000 kilometers away. So please explain to me double materiality, and if you can, tell me I don't need to worry about it.
Well, if you're complying with S2, you don't need to worry about it. If you're complying with other frameworks, you may need to worry about it. To understand what double materiality is, you kind of have to go through all of them first. So we've got our financial materiality, which we know is our accounting definition of materiality. And that is the impact on the entity itself and its ability to really create value in terms of monetary terms. That's what we consider to be financial materiality. When we look at impact materiality, we're looking at it from the perspective of the entity and its impact on the environment around it. So those are really less about the financial impact and more about the actual physical impact of the entity and its operations. Double materiality, therefore, focuses on both the inward impact and the outward impact of sustainability. And this distinction is really important because when we look at financial materiality, we're only looking at meeting the information needs of primary users of general purpose financial reports. And those are our existing and potential investors, lenders, and other creditors. IFRS or the ISSB has gone a step further, and they really only focus on investor information needs. When we look at impact materiality, we're looking at a much broader set of stakeholders that can go well beyond primary users of general purpose financial reports, and it doesn't actually have to include them at all. So we're talking regulators, communities which are affected by an entity's operations, advocacy or like charity groups, not-for-profit entities, activists. These are a whole range of other stakeholders whose information needs that you would look at. Employees as well are included in that stakeholder group, or may be included in that stakeholder group. And then when we look at double materiality, we're saying we're doing the multiple stakeholder approach, but we are explicitly including primary users of general purpose financial reports as one of the stakeholders that we are catering to. So from the perspective of materiality, there is obviously a risk that in complying with a double materiality framework, you miss out on primary user information needs. And that's because of the stakeholder base that you are focusing on. And from an assurance perspective, this also might create a problem because from an assurance perspective, if you're just doing your engagement in compliance with your Corporations Act requirements through ASSA 5000, then you are only doing your assurance engagement with the intended user defined as being primary users. So you don't care about anyone else's information needs, you only care about the primary user's information needs. But if you're a preparer preparing a double materiality framework or complying with a double materiality framework, you might find that there is one piece of information that only your primary users really care about. And because it's not a common information need, and that by that I mean it's not information that's wanted or needed by a large range of your stakeholders, then you might miss or you might not make that disclosure because it's not identified as a common information need.
I'm just a very simple old accountant that has read S2 a lot and reread S2, and I go, where in S2 is impact disclosure?
There is no requirement for impact disclosure in S2. S2 is financial materiality only. So
again, in a manner just framed with accounting standards, can I put impact disclosure in to my climate statement, even though I'm supposed to be preparing my climate statement in accordance with S2?
If you are required to comply with S2 or disclose a climate statement in compliance with the Corporations Act, this is where things start to get a bit messy. For the purposes of compliance, it may be easier for you to separate out that information, so to ensure that you're not obscuring what has been defined as material by the Corporations Act, or not really the Corporations Act, by S2. We do have this very strong understanding of obscuring information or immaterial information obscuring material information within a financial statement context, and that is included in our definition of material. So from the perspective of a preparer who has to prepare a climate statement in accordance with the Corporations Act, in accordance with AASB S2, you have to be very careful that you're not obscuring material information that's required by law and regulation with immaterial information, which is your voluntary disclosures that are not required to be disclosed at all. So there are different approaches to this. You might have a separate sustainability or ESG report that you disclose outside of your annual report, and it's subject to different reporting timelines, so you don't have to worry about it as much, or you might only update it, say, every 2 years, and keep your climate statement as your primary compliance document within the annual report. But you can also include a detailed index if you are going to keep your sustainability report in your annual financial reporting package. Just have a very detailed index that cross-references to exactly where each disclosure that is required is located, so that users can easily identify it and your regulator can easily find it as well.
If you're finding this discussion helpful, please take a moment to click like and subscribe. It helps others in the financial reporting community discover financial reporting conversations and keeps you up to date with every new episode.
Definitely as a man, or certainly the people I speak to, my client base, which will very likely be more group 3, they are going for or a lot of them are going for a minimalistic view of the world. So this idea that they'll go be, if there's no need to disclose impact, I would imagine it's very unlikely they will ever go to that length. So leading on from that, when you tell me double materiality involves this impact concept, since I'm assuming, and S2 does not require impact disclosure, in my paraphrasing it, I'm still happy as an Australian auditor, I don't have to worry about double materiality
No.
on
Not
an
unless you're
on a S2
yeah.
statement.
So on an S2 basis, no, impact materiality is not something that the assurance provider will need to worry about. It only becomes an issue if your client tells you to expand or wants you to expand the scope of your engagement to cover other aspects of sustainability reporting or to go beyond what's required to be assured in compliance with ASSA 5010, which is the phasing in of assurance over a few years.
I think that would be it's a relief to me. And this myth, I sit and listen to everybody actually just throwing out the phrase double materiality. Very few people have explained it as well as I think you've just done it to me, but they throw it out there and we're all going to be doing double materiality. We must worry about double materiality. And doing that in an English or an Australian accent is just not appropriate at the moment. So thanks for that reassurance. I've got everybody rushing around telling me S2 is going to save the planet and I've got to worry about this and I've got to worry about this. So must I have an emission target that I'm going to save the planet?
You don't actually have to have a target in place. If, for example, your greenhouse gas emissions are not material to your business, then it wouldn't make sense for you to have an established target that you measure your emissions performance against. So it's really important that companies or entities focus on what's material, and that if they do decide they need to measure performance, that they set a goal or an objective or a target, either one, and measure their performance against that.
I hope it stops greenwashing. So I hope I'm going to save the planet, I'm going to do this. I've therefore announced I've got a target, and now I have to report my progress against that target. So I hope that will make a lot more transparency against greenwashing.
In theory, it should, but we'll only be able to tell over time. As we've seen more recently, obviously with jurisdictions which are a bit more ahead of Australia in setting climate reporting, like the UK and New Zealand, we are seeing companies either go back on their targets or revise their targets to something that's a bit more realistic. So we do, it takes years for this kind of reporting to settle down, mostly because it's in such an immature space at the moment, and we're developing our capabilities and our understanding as we go. So it wouldn't be unusual to see those targets or the performance and measurement against targets change over time until we get to something that's realistic and reflects the actual situation a bit better.
For all my cynicism, one of the key benefits I do see out of S2 is the transparency on targets, including they move, they're not achieved, they're a bit certainly flexible and developing, but I think that will provide useful information.
Yes, it'd be very useful information.
Okay, the next one, as a person who likes some of the SASB, I know. So, do I have to disclose industry-based metrics in my S2, in my climate statement?
If you are complying with IFRS S2, you do have to consider and look at industry-based metrics. But for the purposes of complying with AASB S2, you don't. So this was one of the only areas, actually, that the AASB carved out of the standard. And that's just to say that you don't have to disclose industry-based metrics and you don't have to refer to the IFRS Foundation's SASB or their industry-based guidance that they issued alongside S2 at the time. And the reasons behind this were very much because at the time the IFRS put out all of their work, it was done very, very quickly, and a vast majority of standard setters didn't have the capacity or the time, really, to go through over 700 pages worth of industry-based metrics and get good quality feedback on those metrics. So the AASB decided for the time being, until we've had the opportunity or until Australia's had the opportunity to have those requirements go through the appropriate due process in Australia, we wouldn't actually require companies to use it. However, there is a project on the AASB's agenda to look at the SASB standards, to look at the IFRS Foundation implementation guidance or industry-based guidance that accompanies their IFRS S2 and try and Australianize it or make it make sense from our perspective. Because there are some very, I guess, strange requirements in there that don't quite make sense when we get into Australia and our, I guess, the structure of our industry as well.
Thanks, and again, recapping, if I was preparing a statement in accordance with IFRS 2, I must disclose SASB information.
You have to consider the applicability of SASB and the IFRS industry-based guidance that accompanies S2.
A number of Australian entities will not be able to say, I comply with IFRS S2.
If they're only complying with AASB S2, you cannot, unfortunately, state direct compliance with IFRS S2. But there's nothing wrong with that, really. We're not seeing a lot of jurisdictions have a copy-paste of IFRS S2. So because sustainability is so jurisdictional specific, everyone has their own things that they're focusing on. Everyone has aspects, or like due to their geographic location, things that matter more or things that matter less. So there is this, it's normal really, definitely from my perspective and my experience as a standard setter, it would be normal to see some variation from jurisdiction to jurisdiction. And I think in this case, Australia made a very strong decision around industry-based metrics, and we sent a very strong message that unless it's been through appropriate global and domestic due process, we were not willing to just sign into legislation, things that we weren't fully, we didn't know the consequences of and we didn't fully understand. And that really came not just from the AASB, but from the AASB stakeholder base, who provided that feedback up to the AASB at the time as well. They were not happy with what had been proposed in the SASB metrics and what had ended up being in the IFRS industry-based guidance, because it didn't make sense from an Australian perspective and it didn't align with our existing industrial classification system either. So companies were very confused as to how they would apply the industrial classification system that's required by SASB or the IFRS industry-based guidance versus how they actually have to report in Australia under our own industrial classification system.
And I know we've talked about this. You see, I am 100% enthusiast for global comparability. I believe in the theory of adopting IFRS accounting standards conceptually lowers the cost of capital in Australia, makes our financial statements more understandable to overseas investors and more trusted from overseas investors. And I know when we did a IFRS, and this is Australian version of IFRS, even though technically we were actually IFRS plus, that we prohibited certain treatments, but IFRS was IFRS plus. Users, Europeans, were very well, it's not real IFRS. This isn't real IFRS. It's this weird Quango Australian version of IFRS, so therefore I don't trust it. And I still think now saying, even explaining, well, this would be the nice badge from the ISSB, and well, this is just a weird Australian version that might not give me the same comment. I find that disturbing or disappointing.
Yes, I think a lot of people do, and I think it definitely wasn't the ISSB's intention to have jurisdictional variation, but Australia is definitely not the only jurisdiction that has to permit for jurisdictional variation. So we're not alone in this. We're not the only ones who have made like minor, and I say this because it is very minor, changes or tweaks to S2 or S1 to get us to where we need to be in the short term. But that's not to say that it won't change over time. So as with all things, we might start off where we're getting most things consistent in terms of climate reporting, jurisdiction to jurisdiction. Most things are consistent and most things are aligned in terms of S2. There's a couple of, obviously, those fringe issues that we're all worrying about and we're kind of fixating on because it's not the same. But at the end of the day, this kind of standard setting takes years to settle down. As you'll see, jurisdictions will change their requirements. Legislation takes much, much longer than our accounting standards, than our reporting standards to change. So everything will even up eventually. There'll be changes in legislation over time. The IFRS will soften in some aspects or have more stringent requirements over time until we get to a good midway point where most of us are reporting on consistently the same thing. And that improves comparability. But as we all like to say, Rome wasn't built in a day. It's going to take us a minute to get there. But to be honest, again, my experience in standard setting, I'm surprised we've managed to get to the level of consistency that we have and the level of alignment that we have globally on just this one topic.
And I keep on listening to that the ISB are doing projects on the SASB standards, the industry standards, and are possibly Paretoing the top few that they might tidy up. Is that right?
Yep. So it's an interesting approach that the IFRS has taken with SASB. So SASB is actually not subject to the IFRS Foundation's due process. It's not. They don't have to apply the due process handbook. So a lot of the work that they are doing is being done in the background and it's not being done publicly, which is disappointing because from a standard setter perspective, you would really want to see SASB up front and in public and have those board members who are part of the subcommittee that look after SASB. You'd want to see them and hear the discussions, hear the debates as to what's going on and how they're trying to internationalize it. But the IFRS obviously does currently have a project. They are currently consulting on the SASB standards. Again, it's such a large volume of work. And while the IFRS Foundation may have the resources to go through over 700 pages of industry-based metrics in a fairly short space of time, it's going to take jurisdictional standard setters much longer because our jurisdictional standard setters are quite small and they're not necessarily resourced as well as the IFRS Foundation either. And they also have to do a lot of stakeholder outreach compared to what the IFRS Foundation is used to doing as well. They need to really get their hands dirty so that they can understand what the effect on industry will be within their jurisdiction, and that takes time. Now,
as a man who's read very, very high level some of the SASB, they feel amazingly North American. They just feel American. is that changing, or is it still? Is it an international effort into the SASB process?
So SASB was originally based out of North America. I think that's where still primary, like a vast majority of their activities occur. While they have made claims that they are international and they went through an international due process, it's just not at the scale of the IFRS Foundation, and it's not to the same level of quality as the IFRS Foundation either. So it's not comparable, unfortunately. What that means is that in order for SASB to appropriately internationalize itself, it does need to ensure that it is like actively and aggressively going after feedback from jurisdictions other than North America. And that's where the IFRS Foundation comes into play. They have a global stakeholder base that SASB can tap into. But again, these things take time. It might not be possible to do everything all at once. Certainly the industry-based guidance that accompanies IFRS S2 is a big improvement on what was originally in SASB. And now again, as they're going through and trying to further internationalize their requirements and the SASB requirements, we'll see another layer of improvement again. But that does not mean it's going to be perfect, and it does take time and it does take years. Mostly because I think one of the biggest flaws of pulling a framework or a set of standards from North America in particular, unfortunately, is that they are very much a compliance framework. So it's very much framed as a checklist of disclosures or a checklist of metrics that you either disclose against or you don't. In Australia in particular, we love to exercise judgment, and we like to have the ability to say no. We don't want to disclose that because it's not material. So we are very adverse to being told what to do, being told what to disclose, and we do really appreciate and like our judgment. And it's the same in the Europe as well, and the European standards. There's a lot of exercising judgment to ensure that you're only disclosing things that are relevant to your business, that are relevant to your company, and that are relevant to your stakeholders or your primary users.
Now, again, I love the concept of industry-based because the broader brush, there are certain industries emit this, methane blow-offs this, doing this, that the principal 30,000 feet requirements would be far more informative if I was down to exactly that industry. So I feel the broad brush principles allows people not to disclose what a user might be really interested in. So I'm obviously an industry support. I'm an industry support.
I think we'll get there. We will get there, but it's very difficult to compare like with like when they're not alike at all. Every company is different. Every company is structured slightly differently. And you can't really, if you're boiling it down to individual metrics, you can't compare a Rio Tinto, for example, to a junior exploration company, but they operate in the same industry. You see these like massive fluctuations in metrics that aren't necessarily comparable anyway and don't give you comparability when you're looking like broadly across the industry. But then, even your Rio Tinto, can you really compare it against BHP? Because they're diversified so differently and they focus on different aspects of mining and oil and gas that, they're in the same sphere, but do you really want to be comparing industry-based metrics when you're not really comparing apples with apples?
Thank you for that. We will wait and hopefully the world will improve, but it'll be interesting, and definitely with Liberation Day and all the other great things that are going on in North America, we we can watch this space. So back to the myths. Thanks for that. Back to the myths. So the myth, I must obtain data from all my value chain. Everybody in my value chain is the way I'm going to be able to report. I'm going to be able to put forward my scope 3, etc. Is that true?
No, it's not. And I think this is where S2 may not do it very well, but the Global Greenhouse Gas Protocol does it very well. And they go through the process around thinking about how you measure your scope 3. And it's a great standard, or it's a great protocol. I think it's the scope 3 corporate accounting protocol. It's got a great approach that can be applied elsewhere in reporting, and it looks at what is material. So your initial step is obviously you need to figure out what is material, and to do that you just get a rough estimate or an idea of the categories, or the suppliers or the players within your value chain. Get an understanding of what is going on and where you need to focus your efforts. And then for what your material aspects of your value chain, that's where you focus your effort, and that's where you try and get more relevant and accurate data, and that's where you would focus your efforts in terms of direct measurement, because as we know, it's just not possible to do everything. It's not possible to get data from everyone, not at this point. We might be able to do it in, say, 10, 20 years when everyone is reporting on the same information. Then it becomes much easier because everyone is preparing the same set of data to get to where they need to be, and it's a lot easier to share that. But to expect a company to be able to demand that kind of information immediately is just, it's not realistic. So focus your efforts on material aspects of your value chain, and really I would only focus on direct measurement in those material aspects of your value chain, because otherwise it becomes too costly.
When we were going through the myths, so I do have to engage with the primary users before I prepare my S2?
Yes, you do. So this is not what we're used to doing.
How and what? Yeah, how and why would be my question too.
The why is very simple. It's because we just simply don't understand what the primary user needs are at this point. It's not like accounting standards or preparing the financial statements, where we can really just make assumptions about user information needs because we're so experienced and well-informed and knowledgeable about reporting, financial statement preparation, and understanding investor information needs in this space. When we get to sustainability reporting, it is, again, it's an immature area of reporting. We're still learning what user information needs are. So in order to ensure you are doing the right thing, in order to ensure that you are disclosing the right information and focusing on the right things that are relevant to user decision making, you actually do need to go and engage with them and speak with them. Again, in the context of S2, it's a lot more straightforward. You're only dealing with your primary users, and you're only dealing with one topic, which is climate. If you are reporting against your IFRS S1, or you're reporting against other frameworks and standards, which are a full suite of frameworks or full suite of sustainability reporting topics, this becomes absolutely integral to understanding what areas of sustainability you should be focusing on and where your efforts should be focused as well. Because you're not just looking at it from a business perspective, you're also looking at it from an impact or other stakeholder perspective as well. And you need to merge those when you're doing a double materiality or impact materiality framework reporting. Again, S2, bit easier. We're only looking at one topic. We're only looking at one subset of stakeholder. So it's a bit easier to navigate because you can focus your efforts quite a lot.
Second part of that question was, how do I engage with my primary users, which presumably is, so primary is are my shareholders and my potential shareholders and financiers, presumably.
Yep. So primary users are your existing and potential investors, lenders, and other creditors. Obviously, your first point of call is always going to be your existing. So look and see who are your primary investors. Is it possible to engage directly with them? Can you do so through other means, such as a survey? There are different ways, different methods, holding roundtables with prominent investor groups that represent large groups of investors as well, or investor advocates that you know are incredibly interested in your work. Speaking to them helps as well, because then you get a better understanding of what's important to them as investors. Talking to your bank, talking to your insurer as well, your insurance provider. These are your really like big ticket items where they are going to start expecting to see information and at a certain quality as well, not just because they're interested in that information in order to make resourcing decisions about whether to provide a loan or whether to insure you in a specific location, but also because they need that information themselves for reporting purposes.
Their wish list they may have their wishes and they may have their desires, but if it's not within S2, can I say, thanks for the feedback, I'll take that in board, here's my S2?
Not necessarily. Don't forget, we are in a fair presentation framework. S2 is a fair presentation standard. And what that means is, if you look at Appendix D to S2, we have this great blanket requirement that says even if something is not explicitly required to be disclosed by S2, if it's material information, if it meets the definition of material in the context of your climate statement, you have to disclose it. Or you should be disclosing it. And that's because we're operating under a fair presentation framework. So you can't dismiss material information or not disclose it just because it's not explicitly listed as a disclosure requirement in the standard.
Back into my auditor world.
Yep.
So I must check or review that the client has reached out to their primary users.
There should be some engagement, yes, to better understand what it is that primary users want. And that's part of the assessing the entity's materiality assessment process. So a strong materiality assessment process would involve a great deal of stakeholder engagement to ensure that you're heading in the right direction.
And if the client said, I can't care, I know what my shareholders want, don't be stupid, and they wouldn't turn up to a round table, and if I hold a round table, it will only be a very vocal minority, so I've not done it.
Companies are well within their rights to do that.
Do I modify my opinion?
No, it just it helps with your risk assessment. So risk identification and assessment. So if the entity has not gone through its materiality assessment process and does not have a strong understanding of what's needed from their primary users, there's obviously an increased risk that you've disclosed incomplete information, or there's a risk that you've identified something as immaterial and therefore not disclosed it when in fact it is material. And your primary users do want that information and it is fundamental to their decision making, but you've made the assumption that it's not. It just changes the risk profile, really, when we're looking at it from an assurance perspective.
And again, all this list of the Appendix D worries, so we've done the outreach with our users, they've come up with this list of I want you to do this, I want you to do this.
Yes.
As an auditor, must I ask for this list? Do I actually want to see what's on the list? And do I get
Yes.
concerned because there's things on the list that's not in the climate statement?
No. So this is where it's like quite interesting. And this is where it becomes, again, it becomes a lot harder from an insurance perspective, because we're really getting down deep into professional skepticism and exercising professional judgment, not just from your preparer perspective, but also from your assurance perspective. Just because your primary users provide you with a laundry list of things to disclose or things that they want does not mean that you have to disclose all of it. Your primary users, again, you are talking to a subset of your population of investors, and they are not going to be representative of the full population. Obviously, there are going to be common information needs that you identify based on your discussions with your investors, with your insurance providers, with your bankers, but you don't have to meet all information needs. It's the same approach that we have to preparing financial statements. Just because one primary user asks for it does not mean you have to disclose it, and it does not mean that that meets the definition of material. It's about meeting the common information needs of your primary users. And you exercise judgment about determining that boundary of what is common information needs.
I'm an emitter. I am into coal. I'm into oil and gas. I support the oil and gas industry. I supply drill rigs, or etc. So S2 is just picking on me, and when I make these disclosures, I'm just going to be pillared because of making these disclosures.
See, I don't think that that's true, personally. And that's because, again, as I said earlier, you can't eliminate your impact. It's just not possible. Companies will always cast a shadow, but it's how they mitigate that and how they manage that that's important. And that's huge. And it's missing, unfortunately, in S2. Because we're focusing on climate only, we're not necessarily seeing the big picture, especially in, for example, like one of the industries that everyone always jumps on is coal. But our coal miners in Australia supply coal to developing countries who may not necessarily have the resources or the capabilities to be able to move to clean energy. Not yet. So what do we expect our Australian miners to do? To stop mining and to stop selling coal to those jurisdictions, to those countries? Do those people that live there not also deserve to have access to electricity and heating? And what do we do if we stop that? What happens? But the coal mining company might be putting a great deal of investment into developing community initiatives, also research and development in those developing countries to be able to make the move from coal to other more sustainable energy generation. But we don't necessarily see that full picture because we're just very hyper-focused on this one aspect. So in some ways, it is a flaw of the approach that we're taking, but in others, it's understandable that we focus on one topic initially, because, again, we can't be everything to everyone, and it would just be absolutely overwhelming to have to report on everything all at once and get a firm grasp on everything all at once.
We need energy, we need heating, yes. we need to travel, and we need to eat, remember the emissions that are from food. So tell it what it is, and everybody can be aware. And
tell us how you're managing that risk and how you're intending to mitigate it. That's really, personally, as an investor myself, that's what I care about. I'm not as worried about what what's going on, but I care about your response to it.
Another myth that we touched on was climate risk and climate risk and climate risk is completely different. It is such a different risk. I have to have a climate statement. The ISB has even come up with how I disclose risks, and then only gave me examples of climate risk, which I find interesting. So, do I have to have I manage risk. I manage sovereign risk. I manage the risk of AI. I manage the risk of competitors and technology. Do I need a separate climate risk committee process to satisfy S2?
No, you don't. You might find it easier initially to set it up that way, but at the end of the day, S2 doesn't tell you to do it separately. In fact, if anything, S2 asks you how you would deal with climate risk in the context of your entire risk management process and your corporate governance as well. So it's about how that is integrated in. And it's not asking you to have a separate register of risks that look at just prioritizing climate risk. It's how do you manage climate risk in the context of all of the other risks that you have to manage.
I think it would be far useful for users, being my primary user, is a register. These are the risks that we actually manage.
Yeah.
And then we might come up with a horrible short list of, no, we don't. We just try and survive from year to year, rather than we've got this great strategic risk management view, short, medium and long term. But it's good to know we are not setting up just separate processes or have to set up separate processes. So I have to do my climate resilience how often? And you said I don't have to do my climate resilience or my scenario modeling annually?
You don't, no. So scenario analysis, there is definitely an acknowledgement that requires a lot of resources and some very niche skills and expertise. And honestly, you don't need to perform it on an annual basis because our climate doesn't really change year on year at such extremes that you would start to think that it would be necessary. So I always use accounting policy disclosures as an analogy, right? We have to still consider their appropriateness every year, still consider whether or not they're material, still consider whether or not we're disclosing the right information, but you don't necessarily change the accounting policy, and you don't disclose the change unless you actually have made a change, right? So I love the guidance in, I forget which appendix, it's Appendix B to S2, that does say that you can link up your scenario analysis to your strategy and revisit it every couple of years or redo it every couple of years. But that doesn't take away from you needing to look at it every year and make sure it's still appropriate and make sure the assumptions and the estimates that you've used in developing your analysis are, you still have to make sure that they're appropriate and that they're still relevant, materially relevant. There hasn't been no material change that has just completely debunked your scenario or made it irrelevant. You still do need to have a look at that. I think West Farmers is a great example. They do theirs every 2 years. So they don't do it every year. They do it on a 2-year rotation. And there are a couple of others that tied into their strategy, and they'll do it every 5 years. So they'll only revisit it every time they revisit their strategy.
That makes sense. But again, this idea of you need to do it every year, you must do it every year. I hear it a lot in a lot of these presentations, but thanks.
Yeah.
Okay, I live in a beautiful world of financial reporting, and I live in a world of recognition and measurement. And the key elements, this standard is how we recognize it, and this standard is how we measure it. Where do I find that in S2?
We don't, unfortunately. So accounting standards, we're very much used to seeing recognition and measurement. So, you know how the accounting standards are broken down. You've got your recognition requirements, measurement, and disclosure, and it's all set out and it's wrapped in a neat bow, and everyone knows where to go and what to look at. For sustainability, and in particular for the IFRS or the ISSB disclosures, and therefore AASB S2, this is a disclosure-only standard. So we're looking at disclosure only. And because of that, they only focus on disclosure requirements, not recognition and measurement. So, and this is primarily because the recognition and measurements sit in those third-party standards that they refer to. So your global greenhouse gas protocol, that's where you have recognition and measurement for greenhouse gas emissions. And then you've got your disclosure requirements that will sit in S2. And when we look at other things like metrics, targets, some other disclosures, they don't actually tell you how to measure, they just tell you to disclose. So it really is up to the company to determine recognition and measurement themselves, and then disclose the information and disclose what what concepts, principles, methods that they've applied in measurement of those metrics, of those targets.
But again, the focus from a lot of these presentations, particularly the auditors I'm speaking to, we're going to have a number. We're going to have scope 1, scope 2, and we're going to have the nightmare of scope 3. That's a number. I can measure that number. I need to check, give assurance that is measured correctly.
Yes.
And that's why all the auditors love it. They found the one thing they can tick and hit with a calculator. So that still has to be measured. But
yes, but you are, unfortunately, from an assurance perspective, again, it's going to be much more complicated, because all S2 tells you to do is disclose it if it's material. It doesn't tell you how to measure it. And this is where professional skepticism and professional judgment play an fundamental role in providing assurance services in this space, because the assurance provider has to step back, look at what criteria the entity is applying, whether they've developed that criteria themselves or whether they've got it from a trusted source, whether it's been legislated as well elsewhere, as to whether or not it's suitable, if it's providing the right information so that we avoid greenwashing. These are all aspects that the assurance practitioner has to think of that doesn't necessarily translate into what the preparer has to think of when they're complying with S2. So it is a lot more work on the assurance practitioner side. And unfortunately, I guess from an investor perspective or from a primary user perspective, we don't see comparability in these, because no one's telling the entity, this is how you have to measure it. This is the criteria you have to meet to recognize it. So you're going to have a whole range of different approaches to measurement initially, until things settle down, until we're able to figure out what is good, what is bad, and then develop comparability over time.
And that judgment area or variation includes scope 1, scope 2?
Yes, because there are different methods to apply and different organizational boundaries that you can apply with regards to scope 1 and scope 2. So it's not just limited to scope 3.
Because, definitely this ins and outs of how you measure the footprint of your electricity can get quite in-depth depending on which pool, which generator, etc. is obviously, it ends up being a guesstimate of this is standard practice or this is a practice or
if you're not using direct measurement on a generator, you're estimating the emissions of that specific generator based on the product specifications. Obviously, it's not going to be 100% accurate because it's just a generalization or an estimation.
The Chinese have got a saying, fortunate are those that live in interesting times. And there is a view of that phrase that it can be used as a curse. And I think interestingly, for lots of accountants and lots of auditors, we are living in very interesting times. So thanks for Siobhan. Anything you would like to add to things that we've not covered in this session, or things that will make me more worried or more confused? Or
not more worried or more confused. It's just more to, I guess, reassure everyone. We are, this is such an immature area of reporting. We're all learning as we go. So I don't think companies or preparers should be too afraid of making disclosures or of trying things out initially and seeing what works and what doesn't. It's all about learning, and it's all about going on this journey together from an assurance perspective. Also, don't be too afraid. It's exciting area that we get to play in, which, we've not had for quite a while. There's a lot of pressure to get it right, obviously, but don't stress too much if you get it wrong. Again, we're all learning, and as we develop our skills and capabilities and our resources and our knowledge over time, we become better at our jobs, all of us in this space. So, there will be misstatements, there will be restatements, but you can only prepare yourself or prepare the climate statement and prepare the assurance engagement based on what you know today, not what information could be available next year.
Thanks, Siobhan. My concern, and massively which has reinforced my concern, is there's too many people out there spreading information that's wrong. There's too many people going out, I will lead you down this very difficult and confusing and developing, moving path. And a lot of the information they're putting out is not correct. I am a very simple, pure accountant auditor. I read the standard, understand the standard, and that's what the preparers and the auditors have to work with. Whereas there's so much misinformation being put out there at the moment, and people are worrying about things they shouldn't worry about, and people are completely missing areas they should be focused on. So that is my just to add to this interesting situation we live in. But thank you very much, Siobhan. Thank you.
Thanks for listening to Financial Reporting Conversations. For guidance on applying accounting and auditing standards, or to access our online training programs, please visit basfordconsulting.com. Don't forget to like, subscribe, and share the episode with your colleagues and contacts. We'll see you next time, where we make the unknowns in financial reporting known.